You're listening to Let Me Speak to a Manager with Frank Cava and Ian Mathews.
What a crock of shit.
Yeah, that was hot mic, Sam.
It's 30 minutes away. I'll be there in 10.
Do it live! I'll write it and we'll do it live!
Frankie!
Ian, you son of a bitch.
Frankie, we're back talking about real estate.
Oh, thank God. Let's talk about this before it goes completely tits up. Hey, we have not come to terms on our Kenny Chesney weekend. Are we making this happen while we can both still afford it?
Yeah, I was going to say, revenue's dropping fast. It's dropping fast. I got to tell you, though, home builders have been they've been reducing staff at an accelerated rate the last couple of quarters, and I know and work with a number of the big home builders, and I'm not going to say it's reminding me of 08, 09, but it's reminding me a little of 06 when we did the first kind of a couple rounds of layoffs, which were sort of easy, right? The first rounds of layoffs are sort of easy in that you're really just getting rid of some people who weren't performing anyway. So it's kind of that first 10% when you're being, it was like 06, right? And at Ryan Homes when we were starting to get, but the shit canning has started to some extent, and if things don't pick up, I think will accelerate. And you were just at a single family, the meeting in Miami that you go to every year. So you've got your take on the retail business that I want to hear about today, but shit canning is starting. I don't know if it started in your neck of the woods with your folks, or if it is late cycle.
So we started that about 2 years ago. You told me that somebody that listens to this told you that I'm a little bit ahead. We had 52 employees 2 years ago, and we have 26 now. We are lean and mean. I've got it's pretty tight. So we did it a while ago. I was having a conversation with someone that is a mutual friend of ours. I went to dinner with him last night, and he was telling me one of the big builders has 18,000 employees, and he goes, I can completely see them taking 1,800 off the top pretty easily, and I can see that starting to come. So I think there's two different things at play here, right? I think the people on the builder side are ready to go. Builders know what they're doing. They're seeing the trends. They were growing and ramping for scale, and that ramp and scale has had a wet towel put on top of it ever since, Liberation Day. The market just hit up, like someone just yanked the emergency brake. So I was at a single family residential conference, a little different. This is for investors who are in the space of building BTR or build to rent. And build to rent is houses that are main purpose is to have a renter in the back end, not to have a back end buyer. So what I put together this agenda, and he and I were reviewing it, and the first thing he said, the first thing on the agenda is rates are the dominant force. And Ian goes, I completely agree with point one, but so do I. And what I notice about the builders, and I notice about this industry, BTR is new. BTR has not really started prior to 2011. This is their first back end of the cycle. Builders are ahead. People who were at this event were basically saying, I think prices are going to go up, with a fucking straight face. So what I think is that I think there are some nuggets that I pulled out of the event that we're going to talk about. I think there's a silver lining here, but I do think that we are in for some disruption, and I think you're seeing it. So Ian and I were talking before we hit record, markets that he's seeing that are somewhat stable. The markets that are somewhat stable are the markets that did not have enormous run-ups. Richmond didn't have a huge run-up, it's relatively stable. Charlotte didn't have a huge run-up, relatively stable. Net migration markets, Florida, Texas, Idaho, Arizona, smashed. They are getting just hammered on prices because they had the biggest gains, and those are the places that have the biggest pullbacks. So I think the reality is it's coming. We talked about this about 6 weeks ago on something we recorded. I think there's pricing pullback, but I think the home builders are more prepared than investors because home builders have been at this 100 years, and build to rent guys have been at it for about 12.
Yeah, and especially the big builders, they're just big builders are very rational. Whenever you see pricing in the market when it goes down, Frankie, there's two big contingents that can get involved. Last time it was the banks that drove pricing down.
Yep.
Not so much the builders, right?
Yep.
The banks got all these foreclosures, and banks hate being landlords, and banks will find the market fast, meaning they will give the shit away to get it off their books because they've already written it all off anyway as a loss.
Yep.
So they just don't have the servicing departments to be landlords like you. So they're getting rid of things as fast as they can. But the other contingent that drives prices down are home builders, because home builders, they're not built to sit on inventory. They have takedowns, they have contracts, they have covenants, they have debt, and they will find the market, especially the big ones, will find the market fast, meaning they will get their price in line. They've been doing it so far, Frank, with incentives. So D.R. Horton, in a normal market, maybe 3 years ago, they average like 2 to 3 points builder incentives. They might give you some cash to close. Maybe they pay for a point of your interest rate in origination fee, but typically a little bit of cash, and that's about what a big builder will give. In their last report, they came out and said that they were closer to 12 to 13 points average on deals in some markets. That's it's meaningful. It's a big deal. But what the big builders will do is they will rationalize their costs. They have heft. They go lean on their trades. They're going to go lean on all of their supplier relationships, who are, those relationships, they're getting less business these days. So they have these monster purchasing arms that can go drive their costs down, but they're also going to get their overhead in line. They're going to do that fast. They're going to take out non-customer facing positions first, right? Corporate positions that don't make sense. But then they're going to start looking and force ranking their people. And, that's when by the way, did you know shit canning, that comes from an old English term. The old commode used to be just a can filled with shit. They would go out in the backyard and they would shit in a can, but they would throw anything in a shit can that they wanted to get rid of. So it was just a big can. And so the term shit can wasn't always for firing people. It was like you'd shit can anything that you just wanted to get rid of, something you could dispose of. And it kind of quickly made its way into the vernacular of the corporate world, so that someone losing their job was getting shit canned. So didn't know if you knew that. I thought I would educate you, because you are very good at shit canning people, but I wanted you to know where that came from.
That is important to me. Thank you for that.
But you mentioned interest rates, so I have a little different take on this. Sure, the rates, I think, kind of broke the back of this market, and rates going up broke what I think was a bit of a bubble with pricing. But I don't think rates are going to be a driver of fixing anything. I think even if rates went down a point, into the low sixes, high fives, I don't think that's going to change anything about the dynamics of this market. If rate was that important, all these incentives that builders are running, and they're running a lot of them, 4.99, come in and buy now. These guys have all been buying blocks of rates with bought down rates, and it's not doing a lot. It's not driving the market.
I disagree with you for this perspective, and this is why. If the people could sell their house with the same rates that they're buying, they would sell and they would move. But the problem is they can't sell with that number, right? So I went through this exercise this morning with my sales team. At 3.5%, at $100,000, it costs you roughly $850 a month, principal, interest, taxes, and insurance for $100,000. At 7.5%, it costs you 150%. So it costs you about $1,250. And over the course of the loan, that $100,000 over 30 years at 3.5 is only $160,000, and it's $270,000 at 1.7. The numbers are staggering. So the problem is it's not that the builders can't incentivize people to be interested. The people are most likely, there's two distinct markets happening here. If you're selling something, you got to have someone who can buy it. And if you can't get those same interest rates on the buy side, you can't do it. And most of the market isn't sophisticated enough to figure out how to lower their rate and give someone a teaser rate to move in like the builders do, because the builders have captives. The other side of it is in the sub 300, people are really, really, really struggling to get in because it actually makes more sense to rent. It's cheaper at today's rates. So if there was a universal cut in rates, I actually think there would be an uptick in volume. But right now it's a closed system, and only one party is getting access to the lower rates, and it's causing a loggerhead.
I like when you use words like loggerhead.
Yeah.
Where'd loggerhead come from, Frank?
Shit can. It was a direct derivative of shit
Are you
can.
talking about logs again? There's a derivative of shit canning. The old loggerhead.
It's old
Ellie,
English.
get the plunger. I got a loggerhead here.
Shitters Club. It's before Old English was influenced by the French.
Oh man, I think there's something here though. The psychology of
Correct.
real estate, I think, is powerful in that we saw in 2004, 5, even 6, investors were continuing to pay prices that were obnoxious. Home prices doubled in some of the craziest markets, and investors were continuing to buy. It wasn't until they found out that prices were dropping and that became part of the public view that the market just stopped for us, right? Like it went on much longer than it should have gone, with pricing not making any sense versus incomes. And it really, when pricing started to drop, you start to run into a whole other host of things that have nothing to do with interest rates. You run into the psychology of, I don't want to catch a falling knife. I don't want to buy something that's going to be worth less tomorrow, because there's a big, in real estate, yeah, it's shelter, sure, but there is a big component of speculation that is no different than the stock market. When do people sell stocks? They sell stocks when the price is dropping, and they buy when it's at all-time highs. It's the worst thing they should do. It's not what Warren Buffett would tell you to do, but it's what people do. It's psychology. And so right now, especially in some of the sand states and some of the hottest areas from COVID, the news reports are running that pricing's dropping, and it certainly is in those places. That keeps people away from doing anything. They freeze, they panic. They almost need assurance that pricing has at least flatlined and is starting to go back up before you get meaningful demand back into the market. And I don't see anything happening in the geopolitical realm, in the economy. I don't see any one big event that is going to drive a lot of demand for real estate in the next 6 months, at least until next spring.
Why did you recently move?
I moved largely because my wife was all over me to move. She'd been wanting to move for a couple of years, but I no longer had a reason to live next to 4 Little League fields. My kid had outgrown it, and I'm getting close to having 2 kids with cars. So we wanted to have a little bit more driveway space, some other things. No.
So I think you're perfect, and you're perfect for the exact opposite reason, right? People who have the ability to move, that want to move because there is needs. There has been, most people, 93% of people move or refinance within 7 years of owning a home. We have been trapped in an interest rate rise environment for over 4 years. So people's lives have markedly changed in 4 years. In 4 years since interest rates started to tick up, I've added another son. I have 2 kids moving around the house. Like, life has changed. Yeah. Now, I made the move ahead of the market change, but you're insensitive to the market because you have a position where you've earned it and you don't have to participate. You get to make discretionary choice. My point in bringing that up is this. I do think there is a market where if things do meaningfully move, people will shift and move because there's a lot of need. And there's a lot of need for people to go around and kind of sift through and get to a different place because their kids are 4 years older than they were too, just like yours are. But as the market, most people are tethered to affordability and getting as much house as you possibly can. In 2021, before rates ticked up, I have a house at $600,000. That payment was roughly the same as a $1.2 million house. So who the hell is moving from a 1-2 house to a $600K house? Nobody. So the market is just jammed from those perspectives. So what I think will happen, I do think there is need, but these things take time. So if you look at the last series of the last real major downturn, we are talking about 2006. Do you remember when the home buyer incentive program went into place?
No.
It was somewhere between 2010 and 2011. Like Carla bought her house in 2011. So it was 5 years later.
First time buyer credit?
Exactly, which stimulated the market. But it was also 5 years after the builders saw it. So what happens is these things do take time, and there's an adjustment to that time. And what Ian's talking about with layoffs and other things is it's pretty critical on that front end, because you have to stay relevant while the market is being irrational, if you will, to kind of stay with it. What Ian is talking about is a sentiment change. So with home building was not a darling for a very long time. If you looked at the PE, so price earnings ratios, and what stocks traded at, the sector as a whole was hammered. But the sector as a whole recently has been trading at much, much, much all-time highs on PE. So what the company makes versus what it trades at is at a higher multiple, so the cost of the stock is higher. And the reason this is relevant is this sector was sexy. HGTV, people love Joanna Gaines, everybody's into it. Like, I want to be a flipper in my spare time. That's the signs of a bull market. But now the pessimistic market is here. So we're going to get a little deeper into this, but I'm going to come back to this in a minute about how you can force opportunity in today's market, because I think there's actually an ability to do so if you have the dexterity and the flexibility.
There's always a market. So you're right. People at a price, psychologically, people are always trying to keep up with their friends, their neighbors, their family who are moving into nicer places that have things that are nicer than them. I lived in a very nice house on a very nice lot with a great backyard, and there were a dozen little things that I wished were better. And we ended up upgrading all of that. Was it necessary? Absolutely not. I had perfectly fine shelter. It was a great house, but I wanted to upgrade. So I think you're right on that. But I do believe that pricing and animal spirits come into a lot of this.
I agree completely.
If animal spirits drive so much of the real estate market and what markets end up doing, and there's kind of mixed signals a little bit. It's interesting. The big builders, Frankie, sales were up through April. Big builders, like some of the smaller ones, are really struggling with sales, but the cost is great. So just a couple of things from the quarterly report. So Stuart Miller's the CEO of Lennar, and he came out and said that their gross margins in the first quarter were at decades plus low, meaning, yeah, we got a lot of sales. We're paying for that. And that was the first quarter. That's closings. And you and I both know that means that's 6 months trailing.
That's right.
What are the margins going to look like in the third and fourth quarter for these builders? They're going to be miserable. Yep. They're going to be negative in some areas. And so there's a resetting going on right now. And I think if you go look at what happened to sales prices in some of the craziest markets, like you mentioned, Austin, places in California, Vegas again, Southern Florida. If you look at what happened with prices right after COVID, it's not even close to sustainable. And so I think you're going to end up giving a lot of that back over the next couple of years. And it's, unfortunately, real estate is not like stocks, where stocks you could lose like 30% in a month. Look at what happened when Trump introduced the tariffs. We had like 20% like in 2 weeks. So you could go in and I'm buying. I just had 2 years of gains wiped out. Let's get back in. Real estate, you got to move, you got to get movers, you got to sell your own house. It's slow. And the builders on the front end, they start by using incentives, right? Maybe they'll give you a little more for your mortgage. Maybe they'll give you a little more cash to close until it's up to 12, 13 points. But at some point, they just have to cut the base prices. And they don't want to do that. But at some point, they just have to go right size their price. And that's coming. That's next. And I think all of that is still ahead of us over the next 6 to 12 months. There's this rationalizing taking place in new construction, but also in the resale market, which typically trails a little bit of what the home builders are doing.
Like they do in All In, I'll tell Nick to pull up a slide. We don't have Nick, so I'll just do it myself.
Nick, give me the slide.
So here's for our radio audience, what I put up the median price in thousands, and that's the blue bar chart. And if you look at it in 2020, the median price was around between 250 and 300,000. And if you look from 2020 to 2025, and we've talked about this before, at 2024, it had peaked at around 425,000, and it's pulled back a little bit to about 400,000. But what's really meaningful about this is you look at the sales numbers. The sales numbers in 2020 were low because we had COVID for the first roughly 6 months, and then it started to spike. But in 21 and 22, it went way up. So if you look at the volume, so pricing, supply and demand, right? It's pretty simple. The demand went up, prices went up with it. And then if you look, the interest rate started to crater in 21, and that's when the volume started to come down, but the pricing is behind it. I'll show you another chart, and this is really interesting. So in 2019 was the last normal year, and this is a month-over-month chart. If you're looking at the screen, it's in green. So roughly 400,000 units were sold in the month of March in 2019. The month of March of 2020, if you remember, that's when the pandemic happened. We were actually off to a pretty good start to the year, so it was a little bit up. It pulled back after that, which I just showed you. But then the yellow year, interest rates, zero, this is ZIRP, zero interest rate program, is here. So if you look at 2021 with all the stimulus, the money, the zero interest rates, housing went bananas. And then I've talked about this before, 2020 was FOMO. That was the fear of missing out. We started to pull people from 2023, 2024, 2025, those buyers into 2021 and 2. And those are the people who didn't want to miss out. So they overpaid or stretched or got into all these other houses. 2023 was the result of the rising interest rates. 2024 was last year, which is pulling back. And then 2025 is worse than that. So it all kind of works together from a volume perspective and all of these different things. What all this adds up to, in my opinion, over time, is it's going to end up with pricing pressure. So the builders are going to cut, prices are going to come down, things are going to pull back. So if you need cash, now is a really good time. If you don't have a home equity line of credit, you should get one. Banks already know, so you're not going to get the same you would have gotten a year ago, but if you don't have one, you should, or if that's something that you need. And if you can be patient, be patient. Don't be emotional. Like, this is the time where if the fundamentals do in fact work, you're going to be fine. So what they talked about at this conference, I went to 8 panels, which means I saw 40 people speak. I thought 8 of them were actually on point, and I thought 32, and these are people who were selected to speak, 32 of them were out to lunch. So literally 20%, it's the 80-20 rule. 20% knew what the fuck they were talking about, 80% did not. And the people that talked about it, they talked about, like in my world, infill. Infill is actually higher value right now than build to rent. Build to rent's usually in the suburbs. And what happens in tight times is people are like, hey, for the same price, I can live walkable to stuff. I'd rather be there. So what works, keeping it simple, don't overthinking it, and putting things where people really, really want to be is going to win. So like if you're on the market, like, hey, should I sell? Now's not a terrible time to sell and rent, is my opinion, because I think you're still pretty close to the top. You can get a decent rental. And then a year or two, you enter back into the market. That's what I did 10, 15 years ago to time things. But that's kind of where I see the market.
How long do you think this downturn lasts?
So you said this in our tariff episode, and I agree with you. I think it could fucking end in a minute. Trump goes, tariffs are down to 0. We're going to pay a premium for every product that comes in through the world, and GDP jumps. Like, I think a lot of it can be manipulated. So I think the economy was relatively strong, and I feel like it's showing some weaknesses now, but I think it get about face pretty quickly. One of the statistics that's in the notes here is paying attention to unemployment. If unemployment gets up to over 350,000 reported in a week, right? So if you get 350,000 unemployment claims, what ends up happening with that, which is pretty meaningful, is that's a big threshold number that's going to drive the market down. In a normal market, we've talked about this before, in a normal market, it's around 150 to 250,000 people let go in a normal week. During COVID, Ian and I were texting back and forth, and we said it here. It was like 15 million on like 1 week, which was 20x the normal market.
It was out of control. Yeah.
Right. So the two things the Fed has in front of it are are inflation, which needs to be around 2%. And their new target is actually closer to 2.5%, because I think they think there's just problems baked into that market with real estate, and unemployment around 4%. So The only way interest rates will come back meaningfully is unemployment ticks up meaningfully. Otherwise, I think we're in this place where we're going to be kind of trapped for a while with higher interest rates, and I think the market continues to soften.
So yes, you could stimulate again.
Yep.
Which would scare the hell out of me if we did that, because then you start to have a bond market issue.
And we already have a bond market problem.
Where you can't pay back your debt as a country, and there's a lot of bad things that could go with that. The dollar loses its status. I'm not sure I'm in love with that, but that would only just be a bounce at the top of a weird bubble that would make it worse, which that could happen.
Yep.
Bubbles can go a lot longer than you think they can go.
100%.
But really, it comes down to affordability. Like, I don't know that there isn't a big affordability issue still in the real estate market that needs to be, for it to be a healthy market again. And I don't know that we've had a healthy market in 15 years, but to have a healthy market, you need first-time buyers, you need move-up buyers, you need people to feel like they can afford a house without stretching themselves to where they're sleeping on a beanbag when they buy it. I feel like a correction needs to happen for there to be some sort of semblance of normality in the real estate market. Now, whether we get that correction, whether we get enough off of pricing to drive 20-year-olds into the housing market like it was when you and I were in our 20s. Folks in their 20s right now are not buying real estate, and that's a problem.
So I'm going to pivot to the professional buyer a little bit and go this way. Here are things you're starting to hear, right? I mentioned earlier that build to rent is falling off a cliff, and they expect to start 85% less houses next year than they started this year for rents. Material prices are up, interest rates are up, there's supply, so that makes perfect sense. You're starting to hear about now accidental landlords. Accidental landlords are people who are trapped. So what you have to look at is, I can't sell this and get my money out, so I have to just stabilize it and I have to hold it. So I'm going to hold that property and I'm going to turn that thing into a rental. So that's going to start happening more with the professional investor market. The other thing is the big boys,
those were people that were hoping to flip.
Exactly. Or people who have to move. I have to move. You move for discretionary reasons. People have had 3 kids. They can't live there anymore. People are going through a divorce. Like, they absolutely have to move, but they can't afford to sell the house. So they just turn it into a rental and it just stays there. So that's starting to happen. The other thing, if you pay attention to the institutionals, right? The big builders, the big buyers, Invitation Homes, people along these lines. A year or two ago, what I told you after coming back from this conference was those guys had gotten into the service industry. So they like the industry. They've figured out how to commercialize the paper, and now they're making money in kind of hub and spoke ways so they can control more of the cycle. They're not buying. The people buying are mom and pops. Who's more sophisticated, Wall Street or mom and pops? Now, what I will tell you is this: if you're paying taxes to the U.S. government, now is not a bad time to buy a property. Anything you make on the property is an expense. So anything you make is earnings. But with higher interest rates, you're going to make a lot less. So it's not more taxes, and you can depreciate, and you can do bonus depreciation. So you can actually, like, now is not a bad time because the house will come back 20-30% to buy something that hedges you against paying taxes. But these are some of the things that you're starting to focus on. Also, people are not buying high-end houses as rentals. They're buying low-end houses. That's a less sophisticated person. Wall Street didn't buy low-end. They bought new, vintage of 10 years old or newer. The mom and pops are just getting in where they can get in. So there's a bunch of different things changing kind of simultaneously.
What's your take on where inventory is right now?
So inventory is certainly up. Inventory where I am is up in a minor way, but it's just harder to get something across the finish line. People are worried. So they look at the house and it's like, now, like on every house sale, they're like, you need to replace the roof. Well, if I was going to replace the roof, it'd be $25,000 higher. I can't replace the roof. There's not enough margin for it. So what you're getting into is a friendly knife fight with everybody on a deal because of the fact that everybody it's just tight. So things are moving. I've said this before, the higher price points, 500,000 plus, 600, like in my market, 750 plus, flying off the shelves because people have plenty of money and they're like, okay, the stock market might pull back. I need a place to live. Ian, I need to move because I want to move. Those are still going, but we're getting a little bit more inventory in the price point stuff.
Yeah, I think one, it's interesting when you run back a 30-year chart of new construction, we're still nowhere. We haven't been, even in the last 10 years, anywhere near what the country needs from a population growth and from the perspective of how much shelter is needed. We've not been built ever since the Great Recession. We've not been building as much as a country as we've needed to. Now, we overbuilt like hell for 5 years during that period of 03 to 07, really. But I think from a new construction perspective, there's still a relative shortage of prices get in place that could, like, I'm still very bullish on publicly traded home builders over a 5-10 year period. I think they're going to do incredibly well. One, because they don't have as much competition as they used to have. Small people can't get the kind of debt to even compete in those markets. But I think for someone like you who's in a space like yours, I think basic shelter is the way to go. I think there's just not enough affordability on that lower income levels and for younger folks coming in. So your can of paint specials are the way to go, really. And whether you're renting them or flipping them, I think if you're in that price point, there's just not enough shelter at the lower price points.
So I'm gonna kind of switch this a little bit, and what I'm going to talk about is kind of let me ask you a question. If I was going to ask you in the last downturn, kind of what if you were going to break it into components or kind of waves or like what happened with the last downturn, how would you explain kind of what happened through? When prices came back, like what stimulated the market? What got things moving again?
What got things moving, which was, shit, man, if you go look at it, it wasn't 10. 10 was a terrible year. 11 was a terrible year when they were running all the government special cash for clunkers. Remember that?
Right, sure.
The first time home buyer credit. I think you just, at some point, you reach a point where demand started to outstrip supply again, and you started seeing pricing going up, right? Pricing was improving and rates came down far enough where you started looking at it and saying prices came down and rates are so low that it's crazy not to buy.
So what I'm going to do is I'm going to show you an arc and I'm going to explain it. So from about the end of the Gulf War, which is the early 90s, through about 2000 and depending on your market, 5 to 8, prices generally went up. My boss
with storming General Schwarzkopf.
But well, he had nothing to do with the housing market. But like after that, but that triggered the last recession, and between about 92, 93 to 08, around 16 years, it mostly went up with some peaks and troughs in there. But it went up over time. But what happened is when the market started to pull back, Ian already talked about this. The builders got involved, but the builders were moving slowly because they're trying to preserve their price point. And the reason why a builder wants to preserve their price point is because their lots are all purchased with today's pricing in mind. So they have to preserve their price point so their future lots don't get hammered. So they're not ready to take their medicine yet. So they're being really, really creative, and I'll lower interest rates to keep my price the same. It's a game. But over time, what happens between 2005 and 2012, the wizard has been exposed. You see him behind the curtain. And banks get involved, the financial markets level it. So if you look at it from that perspective, from 5 to 12, it took about 7 years for all of the shit to get through the snake, right? Like that was your loggerhead was cleared. So you're all the way through on that. So 12, somewhere between 10 and 12, we can get the exact date, is when the cash for clunkers came in, or it was basically the same program they did with cars on houses, and people started to buy. What that did is it started to free up the bottom part of the market. It didn't affect NVR because NVR was expensive new homes, and a lot of people were just buying shitty inventory sitting on the markets, but it stabilized the markets. In addition, Warren Buffett came out and said this, and everybody else with a ton of money realized it. They went to Texas and Florida and Arizona where houses were on sale, and they bought them for 40 cents on the dollar. So what that did is that stabilized the bottom. And that was between 2010 and about 2014. That's when the hedge funds started to buy. So they stabilized the bottom. And then off of the bottom, Here's what the government did. We're going to give you incentives if you take this old building and you build it. This happened in Detroit. Dan Gilbert bought basically the entire city for what you can buy a nice penthouse for in Manhattan because the government gave him shitloads of tax breaks. So over time, people started to move back into the market because the bottom was stabilized. And once the bottom was stabilized, it started to move. And then once it started to move slowly. And then it got a lot faster. And then it got kind of nuts. And that's the whole arc from about 2012 until about COVID-ish. COVID is like 9/11. It was the market where the market was starting to come down a little bit. But we had a traumatic event. The government cut interest rates because they don't have a lot of tools. They wanted to stimulate people's good mood. They propped it up. And then we had the run from 01 to 06 or 7, whatever you want to say the end is. Same thing happened here. So COVID, 3 or 4 years, same thing. So why does this all matter? So if you look at it from these perspectives and you say, okay, like, how do I play the ball where it lies? If you don't have to sell, don't sell. If you're paying taxes, you can currently buy a house on discount. You're probably going to get better discount in 2 or 3 years than you're going to get now, but it's certainly a discount in comparative. But the other thing that is now becoming in vogue, tax credits became in vogue. Well, what's in vogue now? If I was going to ask you, what are governments doing now, Ian? Like, what's the big push from a government perspective on housing? What's the big push?
I don't know what the big
Affordability.
push.
So if you look at crazy places like California, you can take a single family lot and you can turn into 18 houses.
Where are you seeing a crazy push for affordability? What government stimulus? What are they doing? I haven't seen anything on affordable.
Listen, so what they're doing in the state of California is it's prop something. I don't know the number, but what they do is they allow you to change the zoning. I have friends in San Diego that are buying single family houses that by right, they can now build 16 houses off the back that can all be built and rented as what's called ADUs or affordable dwelling units. The state of Virginia passed about 18 months ago, by right, you can build an ADU on a property. So you can now, I'm looking at this incredibly. So you can build up to 1/3 of the square foot with a minimum of 500 square feet. So if you have an 850 square foot house, you can build a 500 square foot house behind it, and you can turn it into an affordable unit. So what I'm getting at is this. In the beginning, what they were doing is trying to stabilize the bottom, and incentives and things did that. That doesn't work anymore. It doesn't matter. We've stabilized that. So what the government's giving you now is they've changed the rules, and they're letting you, through zoning changes, like not every state, but a lot of states nationally, they have this. So like someone like me, I'm like, okay, if I can't sell on the back end, how do I justify higher rents? I can do it with new units. And if it's too expensive to buy, this is an incredible time to have more rentals. So you have to be kind of ahead of where the market is going and understand that and provide what the market needs. And that's what I'm getting at.
Well, you mentioned California. California is notoriously about the worst place to buy a lot. Like the amount of regulations they have on everything, the red tape they have on everything. So them doing something is just, but I haven't heard of a lot of loosening up of regulations in Florida, in places that also need a lot of that work, right? The Carolinas, Texas, all those places. I haven't seen that mainstream enough. I haven't seen the governments have realized this is a problem enough to go after that aggressively. But like your whole arc, which is great, I like all of it. Home builders reached a peak stock price in 2005, or right around the spring.
Yep.
They didn't touch that again until late 2015, early 16, 10 years. And even the arc of when it started to pick up, when and you're right, the very low end of the market started getting a little bit healthier in 2012. But even then, that 11 to 12, from 11 to 12 to 15 to 16, publicly traded stocks weren't doing much of home builders. And if you remember, even working in those companies at that time, we were just fighting and clawing to go up single digits from the year before. Correct. They weren't great years. They weren't years where you're like, wow, 13, that was a hell of a year. They were shitty years. They were like singles, barely singles, right? Like there were no doubles even.
13 was an absolutely dog shit year to be a home builder. It was an incredibly great year to be a real estate investor because I was buying things for 30 cents on the dollar. So
Yeah.
you have to, like Jim Cramer says at the beginning of his
Because
show,
you're still working out all those lots you had overpaid for 7 years before.
I hadn't overpaid for them. Someone else did. The bank took them back, and now they just wanted to get rid of them, and you could buy them at a lower number.
But that takes years for people to admit their failure because there's
100%.
ego involved. There's the hope that maybe rates will drop. Like I'm seeing a lot of that hopium right now in the market. We just need rates to come back to where they were, and it's like
it's not real.
How is that going to happen? Why is that going to happen? What's the catalyst that's going to make rates go back to 5%? I don't see it. If anything, there's going to be inflation if we keep doing tariffs and we run out this big, beautiful bill. That's just going to jack up our deficits even more. That's inflationary. So if inflationary means rates are going to stay high, I don't see any catalyst ripping rates down aside from if unemployment goes crazy and people's the economy is going to have to collapse. And if that happens, that ain't good for real estate either. Everyone who always talks to me about, we just need rates to go down and sales are going to be better in real estate. I always like to remind them from 2005 to 11, rates went from like 7.5% to 3%. And that was about as miserable a time in history to sell homes. You didn't want to be selling real estate while rates were dropping. It was everything else that was making the rates drop was so miserable that you couldn't sell anything.
So this is my opinion as we kind of put a wrap on this thing. This is the thing I think you should embrace and pay attention to. If you're at a builder and you're listening to us, if you're one of Ian's clients, for example, and you work at the builders, this is going to keep you ahead. And the reason that it's going to keep you ahead is this is all I pay attention to. I spend 60%, 70% of my time worrying about the next recession. And when it comes, I feel like I'm ready for it because that's all I've been preparing for. So you can wish or hope for lower interest rates, or you can say, fuck it, and just embrace the higher rate reality. This is where rates are. So you have to think about what is it that is going to distinguish me from others, and what do I have going for me that allows me to sell where others can't. And if you're in the middle of nowhere, you may have to think if you're in the middle of competing with a bunch of communities that are kind of out in the sticks and the burbs, you may have to think about incentive packages, different things you can do, like getting creative in how you build something that other people don't have and drive that. Maybe what you have is, here's a great example. You got 300 lots and you built 30 of them. Well, maybe what you do instead of building all 300 homes is you rezone 100 of those and you put a shopping center in there with a yoga studio and a coffee shop and a gym, and you change the whole dynamic of what that PUD was supposed to look like. You change it. Those are the types of things that you have to think about because the market is changing. People are going to flock to infill. So if you bring infill to the burbs, you might be ahead of them and it might work. It may not, but in a lot of instances, if you pay attention to what happened the last time, that worked.
Did you just call me a PUD? Because I'm offended.
You heard that. You wanted to hear that, and you heard it. So focusing on affordability and value. What I'm already worrying about, I can't move inventory as fast. I've got stuff sitting 21 to 30 days. It hasn't gotten to 60, but I'm thinking about if I was to build an ADU in the back of this, can I paper this thing and turn this into a rental? And in its simplest form, can I build it, pull cash out, rent it, stabilized, and cash flow it? That's how you used to you didn't turn profits, you turned inventory into cash in the last cycle. I'm already looking at it. I own 300 houses. I've got another 30 or 40 that I'm thinking about selling, but if they don't get to the right number, I'm going to pivot into this strategy and I'm going to force cash upon myself. Publicly traded builders will be slower here, but some of them got to the same point eventually when they finally started to sell things built to rent. How you acquire is critical. If you already have a land deal signed, you're screwed. You're going to have to just work your way through it. But for those of us that are smaller and have dexterity, think about sticking with what works. Don't chase deals, attract the right ones. Own the relationship on the front end and then target really focused stuff of what you think you can profit on. I've used infill many times. That's where I think the future riches are. And then figuring out leverage of cash. I think this is going to be a really critical time to figure out relationships with people that have money that want a good return. We've had ripping stock markets. If we go into a recession, people are going to be dying for 6% interest, 6% returns on their money, 8% returns on their money. There's $17 trillion in 401ks and $51 trillion if you take 401ks and self-directeds. So in retirement accounts, that's a ton. Can you get people a 7% return? Does that work for you as an investor or as an owner? And can you use those things in leverage and give people a better return than they're getting in this market? These are some of the things that I'm paying attention to that give me strategy points in.
So I'll finish up with, I like what you said about embrace the fact that rates are high. Like, quit hoping that rates are going down. You need to quit thinking that way. You need to just come to grips with, here's the interest rate environment. Here's what it's probably going to be for an extended period of time. What does my business look like? Hope.
That's right.
Hope is going to let all of your competitors get a head start on you who are more aggressive. If you just look at the fact that you don't make the market, you serve it. The market is the market. You can't do anything about it. I think companies in all industries who embrace reality as it is versus what they wish it was or hope it was or what it used to be in the past, those kind of companies go out of business. That's a good way to go bankrupt. The faster you just drop your sunk cost fallacy and say, you know what, some of the deals we were signing in 22 and 23 are ass. We either need to get out of it, or we need to renegotiate it, or we need to reprice or rationalize our staff so that we can still make a profit margin at those lot costs. You got to do it. You got to embrace hoping things are going to just start getting better. Yeah, you might get a little bump to the rest of this bubble, but the fact is we're probably in a slower environment, and that's just where we live. And the last thing I'll just say is real estate's really hard. It's not for everyone. I would just go long Amazon. Buy Amazon stock. You're going to do better than Frank does in real estate. It's just a better investment. Don't do it. Don't do it. Just get out.
So
real estate's hard.
Thanks, Ian.
Let Frank have less competition. You're not as good as him. You're going to lose money. Just buy Amazon stock.
So what I'll tell you is this. September 11th and 2008 were both moments in my career when I learned an incredible lesson. I learned the same lesson. I worked for NBR, and our CEO was different guys at this point. But after September 11th, basically came out and said, the world's on fire. Nobody gives a shit. If we're going to have a bad quarter, this is the quarter to have a bad quarter. Get all your skeletons out of the closet. Basically what he said is take your medicine and do it now.
It's called the kitchen sink quarter in public traded equities. When everyone knows things suck, you take all your losses in that quarter.
Get them out. 2008, same thing happened. I got in an argument with my boss's boss on this, like a big one. I fundamentally disagreed with him, but he wanted us to tank the quarter. And the reason we tanked the quarter was he wanted to throw the kitchen sink at 2008 and 2009. He wanted that to be the first month or the first quarter where the nose of the plane went up, and it did. So what happened in 2020 is I thought we were going to have another one of these, and I moved really, really fast. And ultimately what happened is people who didn't move fast were rewarded because they had all this incredible stimulus, and because they sat on inventory for 4 months, all of a sudden it was more valuable. I actually didn't have the huge win that most of the market had because I moved quick. But I don't think that's reality. I think that's luck. So the same things that happened last time, I see are happening again. And this time, I don't know if the print is coming. TARP was many, many, many years later. Ian just told you 2008 through 2012 sucked as being a builder. So if you're in this reality, get real, act quick, get ahead of it, get out. It's better to take something today than it is to have something potential in 60 days or 90 days. You don't know where the market's going to be. So you have to move with urgency and certainty, and you have to chase after things that you get you just through this period to the next period. And you just don't want to drown. And too much inventory, no cash, those are the things that can cause that.
I'll counter just with a quick example on that from the same company, Frankie, and you'll remember this. In 2007, we went and ripped every single subprime loan out of our backlog. You were forced as a division manager to take the cancellations. You had more specs because of it. And everyone was pissed off because it kind of tanked the year. And they were pissed because some of those loans could still get done. But we still got out, and everyone was saying, why are we doing this? And next thing you know, there's no Centex because CTX Mortgage didn't do that. They had all those bad loans, and they ended up in such a bad place. There is no Beezer anymore, right? Like all of these things happened. I can make the argument that NVR was very aggressive, and it saved them a lot of money by getting out of some of those deals because they went back and renegotiated those same deals with some of those same developers 2 years later once they realize, oh shit, no one's bidding on this. NVR was right, the price was way too high.
The reason that NVR was so aggressive in 2007 is because they went bankrupt in 1991.
They want to see it again. They want to go through it again.
16 years later, people still remember the pain of that, and they're like, we don't want to do it. We would rather deal with an ounce of prevention now than a pound of cure later, and they want to get ahead of it. And that's what we're talking about. But it's also, I mean, it's somewhat dumb luck. In my case, like I found NVR. I grew up in Florida. There's no reason I met that company, but I did. And I was lucky enough to say, this is the place I want to go because I think I can learn the most. They taught us incredible lessons. I speculate in real estate. I learned from the best company in the world who speculates in real estate. So it's like, you got to tighten this shit up and figure it out and get real faster. NVR did it. If you are listening to us and you work in a company that is in this world, embrace the change. Think about it. How do you have more dexterity and flexibility? How do you help your company? This is where leaders inside of these businesses are going to step up and thrive for the next couple of decades. And you can distinguish yourself by thinking about where we're future paced 24 to 36 months. And if we don't get there, so what? The market picks back up, you'll be fine. But if it needs to go that direction, you're ahead. I'll tell you in closing this, Ian was trained at GE. I was not. I was trained at Ryan. And at Ryan, I never had gone through a layoff. Ian had gone through bunches of layoffs. Now, on balance, Ian may or may not be smarter than me. He probably is smarter than most people are. But on balance, we're relatively similar in a lot of ways. But when it came to staffing and aggressively cutting, Ian was way, way, way more comfortable with it because of how he grew up, what he saw at GE. It was part of their culture. And as an outsider coming into our culture, people are like, man, this guy's radical, but he's right. And he was right because of his previous training. So my point to you is you can be radical and you can be ahead if you just embrace the past and where we're going. And again, if the market picks back up, no one's going to say he was too conservative. You sold too early. Nobody ever says that. The only people who complain are the people who sell too slow or too late.
Yeah, I think that's absolutely right. It's if you're posting zeros in sales week after week after week, you're not priced right. You can make all the excuses you want, but you're not priced right. You can blame your sales reps, you can blame the sales team, the training, the leads. You're probably just not priced right. Pricing does fix a lot of problems, and wrapping it all up, don't be a PUD, shit can early, don't be at loggerheads with your business. Right, Frank?
Don't be a loggerhead for IJ's graduation. You got things to do, Ian.
I won't be at a loggerhead. All right, brother. I'll see you.
Seeing you.
If you like what you just heard, and judging by the viewership numbers, you did, hit that follow button and leave us a 5-star review. It helps other people find the show. And it lets Frankie and I know that, a few people are listening to this.